You're listening to Business Insights by BPM, a podcast series in which top-of-mind business imperatives are discussed with the brightest minds in the profession, offering world-class solutions. Each episode will bring you conversations with world-class industry leaders from financial services to technology. Subscribe and listen to each episode of Business Insights by BPM wherever you get your podcasts.
Hi, and welcome. My name is Tara Wilson. I'm a tax director in BPM's Santa Monica office, and I'm aligned with our real estate industry group. Recently, we conducted a survey to obtain some insight into the challenges and opportunities in the current real estate market. Here with me today to dive into and discuss the results of that survey are two of my esteemed colleagues. First up, we have Mark Leverette.
Yes, thank you, Tara. Mark Leverette here, partner and CPA in the San Francisco office of BPM. I lead the national real estate practice for the firm, and we are a growing segment of the firm. So we're happy to be here and provide this survey and look forward to the discussion.
Great, thank you. Also joining me is Brad Kettmann.
Hello, Tara. Thank you. My name is Brad Kettmann. I'm a director in the advisory group, and specifically a member of the CFO services group with advisory. I lead our CFO group as it relates to real estate, amongst other industries we also service. So glad to be here.
Great. So Mark, I'm going to come to you first. Tell us, when was the survey conducted, and can you give us an overview of who participated?
I sure can. Our survey was initiated in September, and we ran it for about a month until October 2022. It went out to about 1,000 recipients, and these were friends of the firm in the real estate industry, specifically real estate executives. So that would be principals and C-suite leaders that live this stuff day to day and have a lot of insight. We're lucky to have a high percentage of them respond. Actually a larger percentage than we had hoped for. And we believe that this gives us some good footing for the responses that we're going to talk about today. The respondents were kind enough to also add some commentary and color in their responses, so we can use some of that data in what we're going to talk about. And the cross-section of industry participants or subsectors was wide, and it kind of matched or resembled the makeup of traditional real estate markets. So that included the big ones were office, multifamily, industrial. We also saw some retail, and there were some smaller groups, including hospitality, construction, and even modular.
Great. Thanks, Mark. So Brad, can you describe some of the central themes that emerged?
Absolutely, Tara. Thanks. As mentioned, there were some very interesting concepts and or concerns that came about, but a centralized line of thinking did emerge. First and foremost, and probably not surprising to most of us, an astounding 75% of the survey respondents reported that rising interest rates are the top reason that raising capital will look different in 2023. That, along with inflation and other market concerns, have real estate investors and or operators rethinking 2023 strategies. Second, real estate investors are holding the line on technology spending, meaning that they're not cutting back per se, but they are not increasing budgets significantly. Of that spend, cybersecurity is a huge concern, as it should be. Our survey suggested a 0 to 10% spend of overall tech budget to be the industry standard for cybersecurity spend. And the last theme that emerged that was also very obvious was the hybrid working model that has been the shift for companies for the foreseeable future, and it's helped retain good employees.
Great. Thanks, Brad. So Mark, I'm coming back to you. What challenges are survey respondents preparing for in 2023?
Well, there were some key themes that emerged, and the top of the list was increasing interest rates. This is the headline that we're seeing across many of the journals that we read, and it continues to be a discussion with our clients. And the survey put it at approximately 75% of the survey respondents put rising interest rates as the top reason raising capital will be difficult in 2023. Related to that, the ability to renew debt or to find debt for new deals, clearly related, but there are discussions that have been had across our clients and within this survey where renewing debt in 2023 is a key concern. And then finally, also related in the capital stack, raising capital. So the ability to raise capital is a clear high on the list item. Approximately 62% think that market conditions will significantly impact their ability to raise capital in the year ahead.
All right. Thanks, Mark. So Brad, what potential opportunities are participants tracking in the year ahead?
Well, one that jumps off the page is to consider investing in tech. If markets are scaring off your competition from technology investment, now might be the time to get a leg up on them. It's also an opportune time to investigate solutions that can help improve operational efficiency in the current market environment. And then the other opportunity is to look at new markets or defer borrowing. Higher interest rates, as Mark said, may take traditional borrowing routes off the table for the time being. Can you explore new funding sources, such as the private markets? Can you find methods to trim costs in the meantime and kind of kick the can down the road on refinances or customary financing?
And that's a great point, Brad. You have to look for strategic opportunities that are cost effective. And we've seen some very creative groups. In the discussions, it was clear that there are areas for firms to concentrate on their people. One of the areas that we're hearing about is giving the opportunity for employees to be polled to hear what they want, such as training, flexibility in their working hours or where they work, new recognition metrics and goals to be set for the coming year. And we hear that there are some levels of prioritization in compensation structures too, base salary versus bonus, and pulling those types of levers.
Mark, that's absolutely right. I found it very interesting that a top focus of our respondents was the emphasis on putting their people first. Most agreed that people were their greatest investment and that prioritizing their workforce was imperative during uncertain times. So we talked a lot about what was covered in the survey. Mark, can you tell us a little bit about what the survey didn't include?
Yeah, I think you can read between the lines when you look at the entire survey. And what was interesting is that what didn't bubble up, I thought, was discussion about the difficulty with office assets. I was surprised that there wasn't much discussion in the commentary, but I also was surprised that we didn't directly ask questions that would have provoked discussion. And so I think we should do that more in the next survey. It actually leads me to believe that there might be a view that there's a return to normal that's going to happen across all markets. Clearly, there's a geographic specificity to how the markets are going to come back within the office. We also could have done a good job of asking more geographic specific questions. And while we did understand where some of the survey respondents were coming from, I think we could use a little bit more geographic questions so we could gauge their optimism. I think that real estate executives are fundamentally optimistic people. I mean, alternative investment requires optimism and creativity. But some of the markets clearly have some momentum that others do not. For instance, in San Francisco now, we're finally seeing that resurgence to downtown. We're starting to see some transition in leasing and some growth and some new use of space. So I think in our next survey, we'll ask more geographic specific questions and ask some more penetrating questions to hear about optimism in your geography.
Yeah, that's a good point, Mark. And I like the generalizations that we use, but I would have loved on a survey standpoint to be more specific. One hot topic that wasn't included in the survey around this time of year is the setting of budgets for 2023 and the concept of property tax appeals. There are well-qualified third-party groups that work on tax appeals for commercial real estate year-round and across the country. For California specifically, Prop 13 mandates no more than a 1% increase in property values, and that's been baked into a lot of reconciliations for owners and tenants. And the concept of appealing that value gets ignored sometimes. But with vacancy today and the difficulty in the leasing market across the country, or really across all real estate sectors, the probability of little to no increase in value is achievable. I think it's worth taking a look at your portfolio and considering tax appeals for properties and markets that warrant the discussion.
That's a great point, Brad. And I think there's other areas that we could have included in the survey and could have put into the survey results when you're reading between the lines. But that's another area where the listeners to this podcast can come in and put comments into the chat. This is going to be in various mediums. So please feel free to find the chat and we'll find you. Thank you.
And if you'd like to access the survey results and analysis, just visit the real estate industry page on bpm.com. Well, thanks you guys for joining me, and thank you for listening.
Thanks, Tara.
Thank you, Tara.
We hope you enjoyed this episode of Business Insights by BPM. You'll find links to any resources mentioned in today's show notes. And if you'd like to learn more, visit bpm.com/business insights. Thank you for listening, and be sure to subscribe for updates on future episodes.